Beware, citizen, you are now departing from the world of allowable opinion. The Tom Woods Show.
Welcome, everybody. It's Monday, August 4th, 2014. Just got back yesterday from my very, very enjoyable weekend in Arlington, Virginia, speaking at the Young Americans for Liberty National Convention. I'll tell you a little bit more about that after my conversation with Charles Calomiris. You are really going to enjoy this, my friends. I remember, I don't know how many years ago it was, but I had an interview with him on my iPod on a podcast that you also may like, Econ Talk, hosted by Russ Roberts. I think it was about an hour long, 45 minutes to an hour long. And I'm driving along listening to this thing, and I didn't want it to end. Like, I'm making up places I don't even need to go just so I can stay in the car to listen to this thing. It was one of the best interviews I've ever heard because the guest was so knowledgeable, did such a good job answering the questions. It was compelling. It was fantastic. So when I saw that Charles Calomiris had a new book out, a co-authored book, I thought, well, now we're having him on my show. So Charles Calomiris is the Henry Kaufman Professor of Financial Institutions at Columbia Business School. He's also a professor at Columbia's School of International and Public Affairs. He's a research associate of the National Bureau of Economic Research. He holds a bachelor's degree in economics from Yale and his Ph.D. from Stanford University. And the book we're going to talk about today is Fragile by Design, The Political Origins of Banking Crises and Scarce Credit. Charles, welcome to the show.
Great to be with you, Tom.
I'm really thrilled by this book, Fragile by Design. I've heard you speak on these subjects for quite some time, and to see this now in book form is really quite thrilling. We're going to have time today really only for sections. Well, as a matter of fact, I think it really is section 2 is the one that I want to focus on. And this is mostly American, the stuff that I want to look at. But you begin, the thesis of the book has to do with bank crises, and that these are not just spontaneously occurring events that have no cause or that have no explanation, or that the explanation is banking just is inherently unstable, or the free market yields us these outcomes. That you are saying something like the opposite of this.
Well, yes. I mean, the first clue to that is that banking crises don't happen everywhere and always. And in fact, in some countries, they never happen. And in other countries, they happen quite frequently. And the most obvious examples are the U.S. and Canada, where over the last couple centuries, the U.S. has had about 17 major banking crises, and Canada's had 0. Canada is a more volatile primary exporting-dependent economy than the U.S. It's a democracy. It started under British rule, like the U.S. It has a lot in common with the U.S., in many ways, same language, they can even travel among us undetected. But somehow, despite the fact that they have more banking credit relative to GDP, not less, and that they're a more volatile economy, they don't have banking crises and we do. So that's an example, that's a clue. Of course, we go into things much more systematically, but that's a clue to the fact that banking crises are not the mechanical consequence of having a banking system. And they're not even the mechanical consequence of operating a democracy, but they are the consequence of particular kinds of political arrangements. And those, in the case of the U.S., run very deep. So that's what our book tries to explain. These banking crises are not just random events. They aren't just, as you said, just intrinsic to the operation of banks or capitalist society. They come from particular kinds of political arrangements, and the U.S., unfortunately, has had a sorry history of those kinds of arrangements appearing over and over again.
When we deal with a term like hyperinflation, we're dealing with a phenomenon that people generally know when they see it, but all the same, there is a kind of scientific definition that it has to be at least 50% price inflation per month. Well, likewise, for banking crisis, again, I think people know it when they see it, but is there nevertheless a more or less scientific definition of what constitutes a banking crisis?
I would say there's a consensus, and that there are different gradations. So let me give you what I think a banking crisis is. It turns out to be absolutely crucial to analyzing these things. You can't, as Aristotle recognized a long time ago, you have to categorize things before you can understand them. So a banking crisis, I think, in the academic literature or even in common sense, means one of two things. Sometimes they happen together, sometimes they don't. One thing is, suppose everyone is running into the street demanding their money back, sort of like It's a Wonderful Life, but writ very large. And banks don't have all that money in the vault, as Jimmy Stewart pointed out. And so bank run happens. Banks have to close down, have to stop providing this access to liquidity for the general population, leading to a crisis of confidence in the banking system. So that's one thing, just kind of a very disruptive set of events. Those things didn't always result in huge numbers of failed banks, but they were very disruptive nonetheless to the payments and credit processes of the economy. Another kind of phenomenon is when lots of banks are failing, not just one, but a lot of them in some sense relative to the size of the economy. Now, exactly where that cutoff is somewhat debatable, but let me explain to you why it's not such a hard issue. There were, in U.S. history, we had these banking panics of the first kind that I described in, for example, 1857, 1873, 1884, I could go on, several of them. But from 1873 through 1907, although we had 6 panics, the worst of those in terms of bank losses as a fraction of GDP, that is, failed banks' negative net worth, to be formal, relative to GDP, was 1893, where it was only 0.1% of GDP. Now, by any modern standard, that is a very small number. To give you an idea, the Great Depression in the U.S. was about 2.5% of GDP, of the negative net worth of failed banks relative to GDP. So when we see something that's about 1% of GDP or bigger, I think we can call that a major banking crisis in terms of failure. Less than 1% is kind of debatable. So I like to use as a simple metric of the second kind of definition of a crisis, about 1% of GDP. To give you an idea about the past, from 1874 worldwide to 1913, about a 40-year period, there were only 6 such events in the world. Banking crises defined in terms of the negative net worth of banks, failed banks relative to GDP in excess of 1%. And in the U.S., we had 6 liquidity crises, none of which, as I said, got anywhere near 1% of GDP. So there were about 12 crises that were severe liquidity crises, all in the U.S., or severe failure crises over that period. So as you can see, we have ways of defining these things, and by that kind of flexible definition of either a liquidity crisis or a major solvency crisis, there were only about a dozen over that 40-year period. If we apply that same definition as 2 IMF researchers, Fabio Valencia and Luke Lavin did, we'll find more than 100 such crises over a similar 40-year period that we're just ending. And so, and the severity is also much greater. The losses of failed banks relative to GDP in that historical period where I talked about those dozen averaged about 2 or 3% of GDP for those dozen crises. For the ones we've had worldwide in the last 40 years, it's about 16% of GDP. So we've had, let's say, about 10 times as many crises. That is, they happen about 10 times as often, and they're about 5 times as severe. So I think that I've made my point. We do have a way of measuring it. We do have a lot of data on it. And the key thing to recognize is we're living in the middle of a global pandemic of banking instability.
You know, I love statistics like these that tell a story that runs 100% contrary to what most people would expect. I think most people would expect, or if I were to go to MSNBC, for example, any host on any of those shows would think that because the experts have increasingly been in charge over the course of the 20th century, that we must have had more stability. And these stupid rubes who are critical of the system or the central bank or whatever just don't know what they're talking about. These uppity peons should stay in their places and be happy that the experts are in charge. But as you say, the results have not been so good. Now, I want to look now at what are the institutional features that seem to lead to these results. And this is something you cover in the U.S. case in Chapter 6 of your book, which is provocatively titled, Crippled by Populism, U.S. Banking from Colonial Times to 1990. Now, if there's one thing that American history textbooks cheer, it's populism. These were well-intentioned people who were fighting against economic behemoths, and you're trying to complicate this picture, I understand.
Well, I don't think we're saying anything that is unusual within the literature of experts on American financial history. So all we're doing, in fact, is summarizing, in fact, at great length with lots of footnotes, the consensus of the literature of all the economic historians. In fact, Tom, one of the amazing things about how there's a disconnect between scholarship and what's reported in the media is the answer to the question about historically why the U.S. was so volatile is not controversial among American economic historians. There is no controversy. And populism is absolutely understood to be at the very root of it in this period of what we think of as sort of this alliance between this weird U.S. banking ownership structure called unit banking and rural landowners, sometimes called populists. And when you think about how important this rural populist movement was historically, it really subsumed people that we think of as the major sort of figures in American history. Thomas Jefferson, Andrew Jackson, Abraham Lincoln, William Jennings Bryan. These are all figures that were really sort of a pantheon of populist thinking from the standpoint of agrarian landowners. And those people had very specific ideas about the kind of banking system they wanted to have. And that's the kind of banking system that creates huge trouble, and that was creating the huge trouble of the continuous sort of process of bank failures and bank panics in the U.S. during the period you mentioned, primarily the 19th and early 20th century, mid-20th century.
Now, this is because unit banking regulation will make any individual bank artificially unstable or fragile, well, fragile by design, as you say in your book.
That's right.
Because it can't diversify and all that?
Yes. I want to emphasize this is an idiosyncratic sort of thing of the U.S. When we talk about other countries and why they are currently involved in this pandemic, it's a completely different story. But let's focus on the U.S. historical story. Yes, the U.S. decided that it wanted to create banks that had one location. And what was the point of doing that? It was basically to create a mutual dependency of banks on their local communities, particularly agricultural communities. So if you're located where I used to live in Champaign-Urbana, Illinois, basically there are two crops in Champaign-Urbana, Illinois, pretty much, and they are corn and soy. And so if you were a bank lending in that local economy, you had a very undiversified portfolio. In fact, any business operating in that local economy would be susceptible to changes in the prices of corn and soy. Of course, that leads to a very unnecessarily unstable banking system for two reasons. First, the bank's lending is very undiversified. But secondly, it's not a very competitive banking system. The reason is that the overhead costs of operating a one-branch bank, as just a bank that runs its own headquarters, are very high. So you don't get a lot of entry and competition into those local markets. And so the interesting question is, why would landowning farmers be so supportive? And by the way, in Illinois in the 1920s, they even had a referendum where there wasn't just a backroom deal. It was popularly, strongly supported to limit any branching. And the answer that I would put forth is that by having a bank tied to you, even though it was charging you more interest because of the non-competitive environment and the risky aspect of the lending, you knew that during sort of moderately bad times, that banker was still going to be lending to you, because what choice did he have? He was going to be a little bit more forgiving during lean times than maybe a bank that has more options, more geographic spread, more different places that it can lend. Of course, when things get not just moderately bad, but very, very bad, you're both going to go down together. So I look at it as kind of an insurance arrangement, if you like, that agrarian landowners liked having banks that were tied to their local economy, and I think that's a story that fits very nicely with the narrative that we see throughout especially the Midwest, but most of the country, that links together these people who really didn't like each other very much. If you read The Grapes of Wrath, there's not a lot of love lost between the local banker and the local farmer, but nonetheless, they were a powerful alliance for preserving this very uncompetitive and risky banking structure, which was unique to the United States. There was no other country on the planet that structured its banking system in this way.
You know, Charles, you say that really what you're doing is just summarizing the findings of a lot of the specialized literature, but that's the point, which is that the typical American history textbook author is not exactly known for keeping up with this literature. And so the old morality play continues to be played out in the textbooks, and meanwhile, people like you and I vainly try to wave our arms in the air to tell people that, there is something other than this comic book version of history that they need to bear in mind. Now, let me add here, Milton Friedman was very fond of citing a statistic involving bank failures in the U.S. and bank failures in Canada during the Great Depression. Do you know about those figures?
Well, I don't have the specific figures on hand, but I do know them. We spend a lot of time in the book talking about the difference between the U.S. and Canada, and we do even focus on the Great Depression, because Canada suffered, in terms of its GDP loss, a very severe loss during the Great Depression, basically similar to the United States, but it didn't suffer bank failures. There may have been one or two, but there were not large bank failures.
Now, the last issue I want to hit on, just for today, I hope we can have you back because there's so much to talk about, and I want to push this book into people's faces the best I possibly can. But I want to say something about the current crisis or the housing boom and bust, because the question that needs to be answered here is, why did banks make so many bad loans? And I think there have been a lot of red herring discussions about deregulation. But the deregulation that did occur does not seem relevant to what actually happened during those years. So why did they make all these bad loans? What were the factors leading them to have that incentive?
Well, there were several factors, and they're all sort of traceable to government policy one way or another. And I also want to say another academic consensus, again, not very well covered in the literature, the popular literature, the press, is that protection of banks is the reason globally for the pandemic of banking crises that we've had, thinking not just within the U.S., but all over the world. If you look at, I would say, about 100 articles that have been written and published in academic journals, and all of the researchers who are working at, let's say, the IMF and the World Bank, as well as Federal Reserve System and the Academy, we're all in agreement that the protection of banks has been the most important influence driving this pandemic of banking crises. And the U.S. is no different. Banks, especially during the merger wave that occurred in the U.S. in the 1980s and the 1990s, when we finally moved away after almost 200 years from this unit banking system, that merger wave happened in a particular way. It coincided with an increasing protection of banks, the expansion of the safety net, deposit insurance, the bailout of Continental Bank in 1984. So if you protect banks, if you tell banks that there's no downside to them from more risk, guess what, Tom? They take more risk. So that's the first ingredient. There was also a lot of monetary policy that was goosing things up from 2002 to 2005, creating a lot of excess credit in the system, driving the mortgage lending. But the most important influence of the three from the government in the U.S. was the subsidization of mortgage risk that was happening through quid pro quo that was happening in the merger process. In order for those banks that wanted to merge in the 1980s and the 1990s and the 2000s to get permission to merge, they had to go to the Federal Reserve Board, and they had to sit through a merger hearing. And in order for them to get Federal Reserve permission, they had to demonstrate that they were good citizens. How do you demonstrate that you're a good citizen? Well, the government had set this up so that you had to get community groups, so-called self-appointed community groups, basically I like to call them urban activist groups because that's more descriptive, to come and testify on your behalf that you're a good citizen. How do they know you're a good citizen? Well, you do what a good citizen does, which is to give them money. How much money did the merging banks give contractually with paper contracts to these urban activist groups as quid pro quos for mergers? From 1992 to 2007, $867 billion of directed credit. The total amount that they gave to the groups through additional so-called voluntary agreements, plus those specific quid pro quos, was about $2.5 trillion. That was funneled through those groups to their constituents. We go through this and document it at length in the book. So the point is a political deal was hatched. You get to merge if you share the rents from merging, which are big because you're now going to be a big protected merged bank operating nationwide. So you've got lots of advantages, market power, government protection, but you've got to share those advantages. In order to get them, you have to commit to share them with specially appointed groups. Now, that is the essence of the political deal that created this very risky mortgage boom in subprime lending. Those three elements are working together: government protection of banks, government subsidization of mortgage risk, particularly to low-income inner-city people, and monetary policy. And I want to emphasize something about the subsidies to the low-income people. That they are not the cause of the crisis. But in order to get the credit that was mandated to them to occur, banks and the so-called GSEs, Fannie Mae and Freddie Mac, had to lower their mortgage standards. And they couldn't lower their mortgage standards, Fannie and Freddie couldn't, without lowering them for everyone.
There you go.
So that's how we got, zero down payment and undocumented mortgages being the norm. And once they became the norm for everyone. And so it's not just a story about low-income inner-city people, of course, but the politics does trace back to that influence, which ultimately expanded credit for everyone. So when you combine loose monetary policy, protection of banks, and targeted subsidization of risky mortgages, guess what, Tom? You get a disaster.
Charles, before I let you go, I want to back up to this point about protection of banks, because I can imagine the average person saying, yes, I understand the incentives that banks have when they realize that there is no downside risk to being riskier with the money that's been entrusted to them. But at the same time, I as an individual need those banks to be protected, because when those banks are protected, my deposits are protected. I don't care that the bank is 40% riskier than it would be otherwise. At least my money is safe thanks to the FDIC. What do you say to that average guy?
Well, unfortunately, the jury is now in on this question. We in the theoretical literature, you can argue in favor of deposit insurance and other government protections, saying, well, maybe it makes everyone safer because the government's protecting them. The problem is you've got this offsetting effect that protection makes you take more risk. And so you're a depositor, yes, you get protected, but you're also a taxpayer, and you have to pay for that protection. As I said, the average of the over 100 banking crises that we've had has cost those countries' taxpayers about 16% of GDP to bail out those banking systems. So, yeah, you're getting protection in your right-hand pocket as a depositor, but you're paying for that protection out of your left-hand pocket as a taxpayer. And there is no question that you are, on balance, much worse off by creating that protection. So if you remember the statistics I quoted at the beginning of our discussion, going back to the 40-year period from 1874 to 1913, which was a period where there's lots of banking all over the world, very, very free capital flows. We were under a very rigid monetary system called the gold standard. You might think, oh, gee, all of that unprotected banking must have been a disaster. But in fact, it wasn't. what's interesting is it was a discipline system. And here's the way I like to put it to my students. If bankers aren't scared, we're not safe. In the old system, bankers were scared. Who were they scared of? Their depositors. They were scared that if any semblance of misconduct by them got out, they would experience a run. They very rarely experienced runs because they were scared, and when they were scared, they were careful. We've lost that. Deposit insurance and other government protections have taken that away from us. Unfortunately, you put your finger right on the problem. It sounds very good and is very politically popular to protect bank depositors. And, of course, bankers use that to get the political protection that they depend on to hatch their risky strategies. And, of course, they're the ones laughing all the way to the bank with their very high salaries and their big stock options and all the rest of it.
Charles, there's so much to talk about in your book, Fragile by Design. I'm afraid we're out of time, but I'd love to have you back to explore some of this further. Are you game for that?
Absolutely, Tom. It's a pleasure.
Is there any way that people can, other than going to Amazon, can find out either about the book or about you online?
I'm so glad you asked. So we have a web page for the book that collects up lots of videos, articles that Steve Haber and I have written, as well as book reviews, and it's at one word. It's called fragilebydesign.com. If you go to that website, you can find out all sorts of things about the book. But I hope that people will still buy it, even after reading all the reviews and all the other articles. Because you really have to get into the weeds of these topics. Otherwise, it's just one person's word against another's.
And it's a big book. There's, as much as you may think you're learning a lot from reading the reviews, you're just scratching the surface of a huge, very interesting, and very important topic. Charles Calomiris, thanks for your time today.
My pleasure, Tom. Thanks for having me.
All right, everybody, a few show notes here and a few notes just about life in general. I had such a great time at the Young Americans for Liberty National Convention this year. August 1st was the night I was to speak, and that is my birthday, as you loyal listeners know, because I mentioned it last Friday. So they had asked me what song would I like to be introduced to, and I had given them a suggestion. They wound up introducing me to Birthday by the Beatles. Well, naturally, that makes sense, and they had a cake for me. It was just great. They had run a little bit behind on time because Glenn Greenwald went unexpectedly long in a video message. So I got up there about 20 minutes later than I was scheduled to. So just before going on, I asked Joshua Parrish of YAL, do you guys want me to go the whole time, or do you want me to go just until 9 o'clock? I mean, what do you want me to do? Do you want me to go an hour, or do you want me to cut 20 minutes out? What should I do? And he said, I don't really know what they want you to do. So I said, all right, well, pass me a note during the talk, because I was just about to go up there. So I'm about 2 minutes into the talk. He comes up with a little note, and it says, this is America. Go as long as you want. Take all the time you need. I thought, that's awesome. So that's, in fact, what I did. I talked about 3 people we should imitate and admire in terms of the Liberty Movement, and they were Ludwig von Mises, Murray Rothbard, and Ron Paul. And it seemed to be quite well received, and I spent quite a bit of time signing books and taking pictures afterward. My wife was with me. We had our youngest daughter, Sarah, there, who is approaching 5 months. I was supposed to keynote the Arkansas YAL State Convention back in, when would that have been? Well, I guess it would have been March, obviously, when Sarah was born, because she was born right around the time I was supposed to leave to go there. So people did, in fact, get to meet her. They heard a lot about her because she was why I stayed home, of course. And there she was, and she was very, very well behaved, especially considering there's a lot of noise and a lot of big crowds and so on, and she handled it quite well, which is good because she's going to be facing a lot of that over the course of her life. I made some progress on my book. I now think I'm just a couple of days' worth of work away. I have to enter in the changes that I marked up on the manuscript. But I'm seeing the light at the end of the tunnel here. It's a book that, not entirely, but a lot of the book collects some of the replies that I've written to various critics, not necessarily personal critics of mine, in fact, usually not, but critics of our point of view. And I've put them together into a book, and I've organized it into different sections. We got a war section, a Fed section, we've got a Ron Paul section, whole bunch of different things in there, plus some of my favorite interviews from this show so far in 2014. I think it's a neat book. I think it may be the most fun book I've written to date in terms of the reader. The reader, I think, will find it very enjoyable to read. But it's not just fluff. Enjoyable doesn't have to mean that it's just fluff. There's a lot of information in there that you might be able to use in some of your own debates. So please keep on listening into the program. I'll give you details on when that'll be out. Of course, people who support the show at supportinglisteners.com will get the Kindle edition of the book. Your support is very much appreciated, believe me, and it helps me pay the bills and also to promote the show. It gives me a budget to promote the show. So I certainly appreciate that. I appreciate all you listeners who have been helping me to get the word out about the show. Make sure and subscribe on iTunes or Stitcher. You can do that easily at TomWoodsRadio.com. Tomorrow, we're going to be joined by Charles Murray. A lot of you know Charles Murray for his various books. Well, he has a new one out, and it's a real departure for him in terms of the sorts of books that he's written. It's The Curmudgeon's Guide to Getting Ahead. Do's and don'ts of right behavior, tough thinking, clear writing, and living a good life. That's going to be a lot of fun. Some of you guys are going to be ticked off at me tomorrow, probably, because you're not going to like things that I have to say, but what fun would it be if once in a while you weren't challenged, right? Where would be the fun in that, right? So tune in for fun tomorrow, and we'll see you then. Thanks a lot, everybody.
The Tom Woods Show.